Hi, so in this video we're going to cover a very important topic, which is the Dupont analysis. We're actually going to hear a lot about the Dupont analysis, and it's actually very straightforward, but it may seem complex if we do not understand the analysis and how to decompose the return on equity and how does this make sense, right? So let's start. The first thing is that the Dupont analysis evaluates the sources through which we can decompose the return on equity, right? So the return on equity of a firm is simply, right, the net income divided by the shareholders' equity. So we have shareholders' equity here, and we have the net income of a firm. Now, there are different ways through which managers and through which a firm can actually boost return on equity. And each one of these ways will have different implications that a financial analyst will be interested in actually examining and understanding to understand the future path of this firm. Now, how can we decompose the return on equity? So the first thing is the Dupont analysis just decomposes and I'll write it right here, the ROE into the following terms. The first term is the net profit margin. And I'm going to go through the intuition behind this, and after that I will just show you how this formula makes perfect sense and how you can actually remember it without even having to have it on a formula sheet or something like that. So we have net profit margin, and then we have asset utilization or asset turnover, and finally we are going to have equity multiplier. So how can we understand in an intuitive way multiplier? So we have, this is our Dupont decomposition of the return on equity. How can we interpret this in an intuitive way? First, this first term that we have here just measures how profitable the firm is. And we all know that the net profit margin is simply the net income, and we divide that by the sales of a firm, right? So we divide that by the sales of a firm. Then we know that asset utilization is simply the sales of a firm divided by the assets of the firm. Now, what is one term capturing? What is the other term capturing? This first term is just capturing how profitable the sales of the firm are. The sales of the firm are. So net income is actually the profit that the company is attaining after reducing the cost and after reducing the expenses, and we are dividing that by each, so we are dividing each dollar of net income by each dollar of sales, right? We're having this ratio of how much profit the company is getting from each dollar of revenues that they are able to attain. So some industries will be able to have higher profitability, higher net profit margins than others. This does not necessarily mean that one firm, if you look at two firms coming from different industries, you just see that one of the firms has a lower net profit margin. You may just think, well, this firm is performing in a non-profitable manner, but you have to look at the industry, because in certain industries the net profit margins are going to be lower, and all of the firms in that industry will share this kind of level of profitability. The second thing is the asset utilization or the asset turnover. So basically this is per each dollar of asset that the firm has, how many dollars of revenue the firm is able to generate. So basically this is an efficiency ratio, whereas the first one, so this is measuring how efficient the company is, whereas the first one is measuring how profitable the firm is. So this is measuring profitability, right? So we have a good combination if we see that a firm is both profitable and efficient. So they are able to generate a large amount of revenues from a small, let's use that example, amount of assets, value of assets, and it's able to produce a small percentage of profits or net income out of each dollar that they sell. The final term in this decomposition is the equity multiplier. So what is the equity multiplier? This is actually very interesting, and at least to me, it seems that this is one of the key elements of the Dupont analysis. Why? The equity multiplier accounts for something that is called the leverage effect. Now, what is the leverage effect? And I will stop explaining this decomposition just to focus on the leverage effect first. So let's assume that you have an investment. So you invest $10, right, of your own money. So you have $10 in your pocket, you invest it, and then, so this is the investment, and this is also equity. Then you attain profits of $1, right? So this is a 10% ROE. And we are all clear on that. Let's assume instead that you invest the same $10, but you just borrowed $9, so this is debt, and you only had to invest out of your own pocket, so this is equity, $1. Now let's assume you had the exact same profit, so it's $1 too. Let's just assume that for simplicity. Now your ROE is going to be 1, right? Net income that you're having divided by equity, so you have 100%, right? Whereas here you had $1 divided by $10 you invested out of your pocket. Here you're attaining a net income of $1 and you're dividing that by $1, which is your actual investment from your pocket. The other is debt. So the higher the leverage of a firm, there is an impact to the ROE that actually magnifies ROE. So if managers are trying to boost ROE on their financial statements, they are actually able to resort to leverage in a way to magnify the ROE. Now, is this a good strategy or not? It depends on how leveraged this firm is. Because at some point, there is something called bankruptcy costs, or the risk of actually not being able to fulfill these obligations, and that could actually lead a firm to a failure. So actually, and investors will be aware of how leveraged a firm is, so it would be a negative sign if leverage is too high. So that's why they can magnify ROE through this third component of the Dupont analysis that we're looking at until a certain point. After that point, it actually becomes, it actually hurts the company in the eyes of the investors and the market. Okay, so the equity multiplier is just assets, and yeah, this is a different color, but it doesn't seem like that. So it's just assets divided by equity. So the name is actually very intuitive. It's just you multiply equity by this multiplier and you have the value of the total assets of a firm, right? Now, this last term is actually accounting for this leverage effect. Leverage effect. And that's it. Let me clarify this as a C. And that's it. How does the formula finally makes perfect sense? If we look at this formula, if you look at each one of these ratios, you will see that this is a way to get each one of these ratios. If you multiply these three ratios, you'll be able to see that you can just cancel this term with this term and cancel this term with this term. So finally, you're left off with net income and equity. So basically, ROE is net income divided by equity. So when we cancel these terms, we are left off with ROE. So that's basically the whole idea behind the Dupont analysis. At least that's a basic idea so that you can get the intuition behind it. Just pay attention to this because this is important, and you will be seeing this whenever you're looking at financial statements, whenever you're dealing with problems related to this topic. You will very likely find yourself reading about the Dupont analysis. So thank you very much for your attention, and let's keep in touch.